Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, July the 8th, 2025, recording this in the morning. Okay, so let's have a look. Obviously, yesterday, a lot of headlines from Trump. He sent out some very cute letters to everyone. Um, okay, so I think the overall situation, let's just see what's basically going on. I think the overall, I would say there's two reactions, is that people or commentators in general, myself included, were a little bit surprised that there wasn't more of a reduction compared to the April the 2nd Liberation Day. And you could see that, for example, if you look at where we were on April the 2nd is in the gray here. Now, in most cases, there has been a reduction. But if you look at some relatively, look at the numbers, they're still all pretty large. The minimum here is 25%, 30%, 35%. So overall, the narrative that that the tariffs are going to be vastly reduced is not happening. And secondly, look at countries here like sort of South Korea and Japan, which are major trading partners with the US and also obviously with other partners. You see here that, for example, Japan 24 to 25%, South Korea 25%, South Africa 30%. But really, like, South Korea and Japan are 25% is quite a heavy tariff. Now, we have to have the caveat here that there's no mention of what's happening with the European Union, nothing with China. But it seems that with the market at highs at the moment, Trump is almost in a situation here where the market's at highs. He's just passed his one big beautiful bill. He's got NATO to sort of spend up to 5%. There's been a sort of few wins, so to speak, for Trump. As I said, the stock market is at all-time highs. So he's probably feeling fairly confident about things, that he has the political capital, maybe the economic capital, and he can sort of push hard here. I think no one is really expecting these tariff rates to settle at these levels. But what does seem clear is that overall we're going to get much higher tariffs permanently, or at least under Trump, than we have historically. And it's interesting, just pulling up a chart here again. I think I showed you this a couple of months ago, but just going back, this is updated for July the 7th here, and this excuse that, a screenshot. You see here going all the way back for like 200 years, whichever way you cut the cake. So you've got the current pre-substitution rate as of basically July the 7th, or the post-substitution rate. So whichever way you cut it, these tariffs are significantly higher than we've seen for, I mean, you have to go back all the way back to basically the Second World War, the 1940s and 1930s, to get to these levels. So the point is that there are going to be substantial tariffs. Now, whether it's going to, end up being 8%, 10%, 12% in aggregate is no one exactly knows, because we know that Trump is mercurial. The second thing, as I was saying yesterday, is that there are four different ways of paying for this. It could be the exporters, it can be sort of the importers or sort of wholesalers, it could be the retailers, or it could be the consumer paying a final cost. But whichever way you look at that, even if that number is sort of spread out everywhere. I was looking at some data yesterday that at this point, import prices in the US are not really changing. And that's reflecting the fact that it seems as though people who are exporting from their country into the US and importing then into the US, they're not actually raising the prices. So it seems at this point as though there's definitely, the tariffs are being paid onshore in some shape or form. So, so it's going to be interesting to see where we get to, and in terms of inflation as well. So, if you look at this, it's just something from Goldman Sachs research. If you just look at the year-over-year core PCE as a guide, there's all kinds of ways of looking at it. Current level, July the 7th, or if you just go for a 10% level, which is excluding those countries like US and Mexico and Canada, which are being sort of excluded, and then look at peaks. So there's different sort of ways. But the basic point, if you look at no tariffs here, you can see no tariffs. You can see that the core year-over-year PCE, according to Goldman Sachs, they forecasted that would sort of gradually get down towards, sort of the Fed's target, basically by the end of this year, early 2026. But depending on which way the tariffs work out, certainly Goldman Sachs is sort of forecasting some form of extra inflation. Now, who knows what's going to happen? Trump is saying it's not inflationary. Other people are saying it is very inflationary. Powell from the Fed, who is pretty important, he is basically saying he doesn't know, but he does want more information to see what happens. So Powell is basically saying, hey, I want to be sort of here in like September, October with a bit more information to see whether indeed there's no reaction or, not too bad, or in fact heightened inflation. So it's going to be quite interesting. And in terms of how this all sort of affects the US economy and everything, as I said, it does seem as though in some shape or form there will be a little more inflation, that there are going to be some more tariffs. Prices will go up at some point. Now, one could argue that the big beautiful bill, which was just passed, that's going to be mildly stimulative in some sense, and that seems to be the fact. But I would argue that the fact that tariffs are being imposed on, perhaps wholesalers, retailers, and eventually passed on to the American consumer, at some point there's going to be a percent or two of a hit to people in the US and companies in the US. Now, you could argue that's going to be offset by a little bit of stimulation from the big beautiful bill. Those tax cuts will continue, maybe. So it's going to be interesting to see. But certainly, what is priced at the moment, if we just look at a few markets, we can certainly see that the stock market. I mean, it's what is that priced for? So we just let's go for the ES, the futures here on the ES. You can see that they came off a little bit just once those first numbers came in, but already today you can see you're up 16 basis points. And at this point, if you look at this chart, this is a very, very, very bullish chart. There's essentially zero technical damage done. We're above those recent highs before the Liberation Day, as we all know. So at this point, this chart is bullish. Trump is feeling emboldened by his political successes, and you could argue sort of diplomatic successes, in Europe, and sort of bombing Iran with, ostensibly, sort of no negative blowback there. So at this point, the market is priced for, I would say, tariffs which it's either been priced in fully, or the market is saying, hey, this is going to be a minimal damage, and the US economy can sort of exist with that, and the US consumer can exist with that. So we are priced for perfection, and you've got to ask yourself, what would potentially cause this to come down? I think it would have to be if the tariffs were imposed in a permanent way at much higher levels than people are anticipating. At this point, the market is essentially doing the taco trade. They're saying Trump always chickens out. Trump, when push comes to shove, he's already pushed the tariff headline to August the 1st from July the 9th. And basically, people are saying, hey, don't worry, he's going to relax for China and the European Union and Japan, and all of these numbers and letters he sent out yesterday is just sort of puffery, and he's just fooling around, and ultimately everything will be fine, and we'll have, maybe a percent or two of tariffs, and that will be diffused everywhere, and it won't be a problem. And in the meantime, we get the slightly stimulus, big, beautiful bill, and the tax cuts have been rolled over and will continue for companies and individuals. And there'll be at some point down the road, this is what Besant is saying, there's going to be deregulation coming into effect in 2026. So it's all good. We'll see. So anything less than that is a problem. And of course, another thing which is baked into the cake, as we can see, is the Fed is cutting. So even despite the political issues recently between Powell and Trump, and the recent sort of labor market data, which has been fairly supportive, the reality is the market literally, actually, here we are, exactly two cuts. So exactly 50 basis points as we speak this morning is priced in by the end of the year. So the market is essentially saying that Trump will chicken out. He won't be that aggressive when all is said and done. There's going to be huge amounts of compromise and, sort of chest beating, but ultimately low tariffs. The economy's got to remain strong. The labor market's got to remain strong. And added to that, yes, we're going to get two cuts from the Fed. So that's where the market is. So you've got to say that anything less than that could be a disappointment. And of course, we have earnings coming up. We have a multiple of 22. I was looking yesterday, we have a earnings multiple of 22. And so, of course, as the earnings season comes upon us in late July, going into August, that, of course, is also priced for perfection. So we have earnings priced for perfection, inflation not going to be too much of a problem, the Fed cutting twice, and, tariffs basically settling at a level which everyone can live with. We shall see. Let's keep an eye on everything. Okay, so in other markets, overnight, we had the RBA. Interestingly enough, the RBA did not cut. That had been 95% priced in, according to the futures markets anyway. But basically, on a 6-3, there was a vote on the Monetary Policy Council of 6-3 in favor of holding, basically citing, the statement's uncertainty, that inflation was still a little bit sticky, still worried about issues. So it's interesting that the Aussie dollar, benefited on that, because that was a surprise, a hold rather than the cut. And as I say, you see here the Aussie dollar sort of pushing up on that. Again, the big picture is that the Aussie dollar is going to be more beholden to what happens in China, the trade war, global sentiment, rather than sort of domestic policy at this point. But nonetheless, in the short term, that's a bit of a of a surprise to the market in the short term. And is it a foretaste of what we might see with some other central banks? So let's say the ECB maybe has stopped cutting for the moment, and we all know what's happening with the Fed, that they are very resistant to begin cutting. So that's kind of interesting. Just in terms of the bond market was very soft yesterday. So let's look at let's look at well, I want to concentrate on the long end of the bonds, because you see here that the long end of the bonds, so this is the ZB, so the 30-year futures, you can see here that they came off quite strongly. And let's actually just look at that on the yield. It's interesting. We're now getting up towards the 5% mark. Now, what we've seen in the past, you can see here 5%, 5%. It did push on up over 5%, but basically as we get up towards the 5% mark, there's sort of a feeling here that that's about it. That will be capped. That there have in the past been dip buyers coming in to buy the dip on the long-term bonds, but this is a pretty sharp sort of upward move, and that was caused. I mean, yesterday specifically, we had quite a lot of corporate issuance, sort of investment grade corporate issuance, and of course maybe trying to get the corporate bonds on to market just before those yields go up too much. So we had quite a heavy slate of corporate issuance. And of course, the whole thing with the tariffs, there is still this underlying sense that possibly, sort of inflation will be a little bit stickier, and prices will go up around the world, and supply chains will be a little less efficient. And also that, the deficit spending is not cutting anytime soon. So I think now what's happening is that the market is slowly getting a bit more information about the real economy. It's getting information slowly about tariffs. And also we're getting information about the deficit, that the deficit spending, the big beautiful bill, I mean to say, so the big beautiful bill was passed a few days ago, and as we all know, there's basically not significant amounts of cuts to the deficit. So there's still going to be the need for long-term issuance. Now, of course, we do have the QRA at the end of this year, end of this month. We'll see what happens if the Treasury wants to kind of tweak that or something. But at the moment, the bond market is basically saying, hey, too much issuance, too much debt, inflation is still sticky. And that's a problem. So we'll see where we go with that. But basically, as we got that, the US dollar had a little bit of support. Actually, just talking about the bonds, just to continue here. So we also saw that over in Germany. We saw the long end of the German curve come off. The books will come off pretty hard. And if you look at some of the curves here, you see here the US, we're getting a sort of a bear steepening here. So you see the steepener had flattened a little bit, but it's starting to resume in the US, and quite strong over in Germany. If I can just find my German yields here. So if you look at the 230s here, you can see here that's sort of steepening as the Buchsel has sold off. The 30-year German bond has sold off fairly aggressively. So a bit of a spillover from the US, but also a recognition. Here's the 30-year here, the Buchsel. You see here that's has been selling off the last couple of days quite strong, and has broken an uptrend line here, and this momentum sort of moving average is still pushing down. So you can see the Buchsel pushing down a lot, and still worried about sort of deficit spending and in Germany. And I was reading something, when was it, yesterday, just about the pension plan, that ultimately Germany cannot afford its social welfare model and its pension plans, and now it's adding to that infrastructure spending, and it's adding defense spending. And essentially this is going to be funded out of probably increasingly larger sort of issuance and deficit spending. And you're starting to see, that's why you're starting to see sort of almost like a structural pressure on the back end of the curve here. So that's what's going on there. And also, of course, there was a little bit of a risk on sort of tone in general. So just to finish off, just want to have a quick look at oil. Not a lot happening in oil. We know that OPEC Plus over the weekend raised production by about 550,000 barrels. The market had been expecting that, so it didn't sell off. We had a bit of a positive sort of I'd say it's sort of a light sort of positive sentiment just yesterday, just sort of in general, saying the tariffs, they've come out, Trump will chicken out, etc., etc. Again, this idea that don't worry, this is just all, we could almost forget about them. So I don't know if oil's a beneficiary of there. As I was saying, looking at the inventories in the US, they're at quite low seasonal levels. Global inventories, it's a bit more difficult to understand exactly what the situation is. But certainly the physical market does seem relatively tight. The front of the curve is still very much in backwardation. So oil, can it push up? Maybe, but we do have the 200-day EMA, which we could be significant sort of resistance coming up here at about 68.50. So I guess that's the next thing to look at. The other thing as well is that the dollar has had a little bit of a rebound. Okay, so first of all, it's bounced off a technical level. We had yields going up a lot yesterday, or actually over the last, let's say, a couple of trading sessions in the US. So yields have been going up a lot, which, in theory could be supportive for the US dollar. We also have stock markets at highs, and, it seems as though, apart from this being a technical bounce, that there was, as I say, this idea that, things are doing okay, the labor market's fine, the Fed's going to cut, that sort of positivity. And maybe that's sort of a positive thing also with the tariff news supporting the US dollar. But again, just from a technical perspective, I don't want to read too much into it, to be honest. I think at this point, it's not really a question of being a buyer of the US dollar, which is not to say it can't have a short-term technical bounce. I mean, most of the fundamental are still in place for some structural weakness in the US dollar. And if we just sort of step back and look at this from a technical perspective, we haven't even breached, even the closest overhead kind of levels here at about 70, 97.80. We haven't breached the 20-day EMA, and technically still this sort of big downtrend, which has been in place since the beginning of February, was still, barely above that. And we haven't even come back to any kind of fib levels either. So I don't even know if we can call this sort of a bounce in any significant sense of the word. Okay, guys, so that's about it. Just in terms of today, no data really, and I don't think we have any Fed speakers. No doubt we'll be getting some tariff stuff and some tweets from you-know-who. We do have actually, we just come in, the small business optimism survey came in this morning at 6 o'clock. So that came in as expected, 98.6, a little bit lower than last time. So that's not horrible, but certainly not sort of pointing upwards in the right direction. Inflation expectations coming out a little bit later. We'll keep an eye on that, but nothing of, sort of tier one, sort of moving, market moving data. Okay, we'll leave it there. Let's keep an eye on the stocks, Trump tweets, anything about the tariffs. And also I want to keep an eye on the 30-year bond yield to see if that does push up to that 5% mark, and what happens around that 5%, whether buyers come in as they have done or not. Okay, thank you. Have a great day.